This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. Hello, investors, and welcome back once again to the Three Wise Monkeys podcast, our very first edition for 2019. My name's Andrew Page, founder of strawman.com, and back in the saddle with me for 2019 is, as always, Mr. Claude Walker from ethicalequities.com.au. Good to have you here, Claude. And Matt Joss from mattjoss.com.
Thank you, Andrew. Very happy to be here.
Did you gents have a nice break?
Very relaxing. Yeah, it's good.
And any,
we had prepared a statement earlier.
We both found it to be relaxing.
Very relaxing.
Relaxing's just a good proxy for lazy, isn't it, at that time of year? So I have to ask the question. I'll start with you first, Matt. Any New Year's resolutions?
Yeah, I do actually have a New Year's resolution. Are we doing investing resolutions?
Yes, I think we should keep it on topic.
Yeah, my New Year's investing resolution, which is kind of a broad one, applies broadly, is just to not complain. I'm trying to not complain about anything.
Complaining's a lot of fun, though.
And take responsibility. So if something bad happens, particularly in the share market, I will recognize the role that I could play or not play and not like complain about the situation.
Now, does that mean you're retracting your I will read 50 books challenge?
I'm still trying to read a lot of books as well,
Yeah, so Matt committed to reading 50 books. Andrew and I committed to reading 12 books.
I committed to having Matt give me a brief summary of 50 books this year. Okay, Claude, yourself, what New Year's resolutions?
Yeah, so my New Year's resolution, investing-wise, is not to sell Pro Medicus this year,
Okay.
Nice.
unless there's some deterioration in the actual business. Twice now I've sold it just because the position size got too large. It's
done a bit of that.
pretty much been a money-losing decision for me so far. I actually even sold some at around 12 and then bought some back at 10.
Nice.
So that wasn't worth it because of tax reasons. And yeah, I'm really trying to just focus on the fundamentals rather than, I guess, portfolio management, which is not what I would tell other people to do. But I think, that's my resolution for this year, just 1 year. And then
nice.
in 2020, I can think about my portfolio allocations again.
It's funny you say that. You've really got to keep an eye on those weightings, but if you focus on it too much, you end up doing a lot of unnecessary trading and often to your detriment. I've definitely made that mistake.
Well, the best thing I've done has been to have an overweight position to Pro Medicus, but it's actually still cost me those times that I have tried
Opportunity cost.
Even my rule of it shouldn't be more than 40% has ended up costing me money.
That's a generous rule.
Yeah,
too.
exactly. It's
That's
not
a
like
really
I
generous
haven't
rule.
been harsh here. But
No position more than 40%.
Yeah.
You're a hard taskmaster.
Well, now I'm
yourself.
bumping it up. So there we go.
That's cool.
And Andrew, what about yourself? New Year's resolution?
Yeah, I thought this year I would try and make more of a focus on being a better seller. I think I'm one that gives management a lot of rope.
Okay.
And I'm an eternal optimist. So I tend to sort of think, right, if news comes out that's not great, I'm very good at rationalizing that. So I'm trying to be. I always think you need to be slow to buy and certainly to some extent slower to sell. But I'm too slow sometimes. So I want to try and speed that up a bit.
Nice.
And
Now,
that's
is that
more from a thesis altered broken perspective, more so than a price profit loss perspective.
Yeah, okay, that's what I was going to ask. Are you thinking more when it's off track and you're not selling quick enough, or the same as me, where if it's gone well but you sort of take profits just because?
I was more referring to the bad side of things. So I've had a few things and they haven't gone my way. I'll talk about them in a bit because I want to do a bit of a review of the scorecard that I've got on Strawman. You'll see some of those stocks there. Probably would have done me a favor if I was quicker to act.
Should we go straight into that then?
Sure. Shall we do that?
Yeah, let's hear it.
Well, so as part of the new year, I thought, it's always a good idea to periodically sort of review your portfolio and your positions. And on Strawman, as you gents know, I've got a public scorecard there. In fact, of course, quick plug, anyone does who wants to log on and create an account. You can share your investment genius with the world. And so we actually started an early version of the beta back in November 2017. So the scorecard's been going for just over a year. I'm kind of happy to admit that I'm beating the market, but it's not setting the world on fire. The scorecard's down about 1.6% versus a negative 2.4% loss for the market. There's 13 unique recommendations in there. There's a couple that I've sort of double dipped on. And it's really been a story of a couple of, often this is the case, a couple of big standouts, a couple of big losers, and then some mediocrity in the middle. So that is thankfully adding up to outperforming the market. But I did take the time to sort of, and my personal portfolio, which no surprise aligns very closely with the Strawman Scorecard, and just sort of to revisit some of these things as we were just talking about here. Is the thesis still in track? Can I still hand on heart recommend this kind of stuff? And I went through that process over the holidays.
Nice.
Right, so
what are the takeaways?
Well, I'm reluctant to talk about one because I know that Claude's going to pile on and go.
So, wait. Let me just ask a general question. So, what's the biggest drag on your scorecard?
It's Catapult.
Oh,
What was your New Year's resolution again, Andrew?
To sell quicker. So it was actually on this.
So, full disclosure, we're laughing a lot for people who or at least certainly I at least lost money on my most recent Catapult investment. So
yeah, well, I thought it was worth mentioning that one in particular. One, because it's definitely been the biggest drag on my portfolio, but two, we actually did a podcast, at least a segment within a podcast episode of it a little while ago. As shares are at $1, and I was saying I think things have been oversold a little bit. And what happened since then was the CFO resigned unexpectedly, no specific reasons given. That's rarely a good sign.
But it's not the first time there's been some sort of resignation.
It's the second CFO in 2 years.
Ooh, that's a...
And so,
Ooh.
yeah, the markets...
Remind me to automate
reaction,
something that checks for that, right?
Yeah.
Why not?
So the market's reaction was reasonably brutal. Shares down 25% further from there. So sitting around 75 cents at this point in time. Yeah. So there was a bit of definite soul searching with that.
Did you miss the ethical equities update where I gave a fairly frank assessment of the company?
No, I read it. I read all ethical equities content
thanks, mate.
with great attention. And yeah, look, I've it's one of these things that when this kind of event is open to all kinds of speculation. So what does it mean if a CFO resigns? Well, it could mean nothing. It could legitimately mean that there's a family crisis, there's a better opportunity. He's not any number of things that are perfectly reasonable.
There's always...
Having said that, I'm fully aware that, generally speaking, I haven't done the stats on it, but it feels to me as though more often than not when that happens, it points to something negative down the track. What is that? Well, that's where the speculation comes into it. Is it something that there's not quite an appropriate level of accounting going on? Is it just that the CFO didn't see much, someone who's as close to this company as you can be in terms of the financials, that they see something that they didn't like?
But also they've put out like guidance a few years in advance. They were always using underlying EBITDA or whatever it is to be their target. Yeah. And I think that's in particular, you see higher turnover of high management staff in any companies that use made up metrics as their goalposts. Yeah. You don't see the big turnover on companies that don't give guidance and just report their profit, basically. And a lot of my core holdings don't give guidance. They never have. It's not compulsory to give guidance. But when you're reading the financial media, it's very easy to get stuck in this idea that everyone has to give guidance, because the companies that are more promotional, that are trying to raise capital, that have got fundies in their ear, that have got brokers telling them this, that, and the other, they're more likely to give guidance. But it's just simply not true that all companies do it.
Yeah, so I think it's often related to capital raisings when companies are giving guidance because they raise a bunch of capital and they give some numbers around that, and then they feel obliged to keep updating on that. So as Claude's saying, it can be a sign that the company needs to keep raising capital, which isn't always a good sign if they're able to reinvest internally.
For Catapult, I think that would be the fourth capital raising. With each capital raising, we're now speculating about future capital raisings, but that would be then the fourth. Potentially, that's like at a lower level.
You'd like to think that there's not one with what they've done recently and supposedly on track to cash flow.
Somebody has to pay those ever increasing salaries.
Well, this is really, I mean, even broadening out.
Andrew, I feel like we talk about Catapult every episode.
I know, and Pro Medicus.
So we're gonna bully you into selling it until finally you sell, and that will be the bottom.
Yeah. So that's one that I've done a bit of soul searching on. MSL Solutions was another one that hasn't done well for me. These guys make software for clubs, stadiums, that kind of stuff.
What do you think's going on there? Because that does have some of the features that we tend to look for in companies.
It's got a lot of features, man. It's a profitable business. Revenue has been growing really strongly. A lot of acquisitive growth in there, but a lot of organic growth as well. They've basically pressed the pedal on the R&D spend. So it's that whole chestnut of that's a great idea if they get a great ROI on that. It's a terrible idea if they end up wasting a bunch of cash. And they've also transitioning, we talked a bit about this theme, in fact, to a SaaS model. So things are going more subscription-wise. So about half of their revenue is recurring at the moment. They're trying to transition more to that. It's a bit of an impact. So you've got a business that was sort of touted as high growth, which still looks as though it's getting a very good pace of client additions, but it's probably going to be a relatively flattish year before growth resumes, assuming a lot of these strategic things sort of work out. So look, that thing's at about 15 cents at the moment. And I think it's well undervalued. I think conservatively 20 cents.
And what are you valuing it on?
I'm valuing it on a sales multiple. You tested me now. I can't remember exactly what it was, but
I just meant like on revenue, or
yeah,
is it actually profitable?
It is, but there's some granular stuff in that which I won't get into. But it's a low multiple of sales, and for a business that ostensibly is growing its sales pretty well. So I'm happy to sort of stick with that. And then on the other side of the equation, we've had some really good wins. EnviroSuite's up a good 33% for us.
Nice.
Pro Medicus up 24%. It's done really well. Also, Nanosonics was a good performance over the period as well. It was up 27%. So yeah, you mix it all together and we've got a fairly flat result. But the important thing was, after that sort of review, I'm happy with those 13 stocks. I'd welcome anyone to sort of jump on the Strawman, tell me what they like, what they don't like, maybe add their own recommendations if they think they've got some better ones. But yeah, that's pretty much a process I went through at the start of the year, and it was a pretty helpful one.
All right, so to be fair, your biggest winner?
The biggest winner would be, actually, it was one that I opened and closed. I actually held this only between April and July of last year. It was EML Payments. It was 35% return over that period.
Not bad.
Yeah, I thought things were too cheap. It got to a point where it was a bit of a premium on my estimate of value, and then also cognizant of the fact that I don't know it as well as I should. So I was happy to sort of take the bird in the hand there.
Excellent.
So what else? While we were thinking over the holidays, I was thinking about the scorecard, the portfolio. Matthew, you were thinking a bit about macro. You were thinking big picture.
Yes, I certainly was. So I guess there was plenty of big macro stuff going on over the break. There was huge swings in the market, particularly in the US, where stocks, were up 4%, one day down 10% the next, some of the big names.
Yeah.
I guess thinking around the new year kind of time, a good time to take a step back and think how things are going. And there's a few kind of trends that I'd noticed, and particularly in Australia. So in the US, obviously, there'd been a big freak out because quantitative tightening is starting to happen. I think that's something that's really underrated.
We should probably get you to explain what that is.
Yeah, exactly. So ever since the GFC, banks have been printing money effectively. They don't like to call it that, but effectively doing that on a regular basis, to the tune of about, I think, $600 billion a year in the US.
This is central banks.
Yeah, it's the central banks. Yeah, so buying basically bonds, creating money and then buying bonds with it, which is just pumping money into the economy. Plus extremely low interest rates. And just recently in December, they decided to raise interest rates. Kind of when the market was already a bit jittery and the market freaked out, and at the same time you have that easing program, the billions of dollars that are being bought every month coming to an end. So
withdrawing all that liquidity.
Exactly. And so the markets freaked out. And I thought it was interesting, one guy in particular, Stanley Druckenmiller, who's probably the best investor ever. So over 30 years, compounded at 32% per annum for 30 years. Which
He's
is
not
better.
well enough known given that.
Yeah, return. He isn't. He's a trader as well. He's not just a long-term investor, so it's a different take.
Yeah.
But his view of the market, he kind of said it was a mistake to raise. He came out publicly. He's in retirement now. Came out publicly saying don't raise right now, even though he'd been saying to raise for years. And the reason was that he kind of studies the sectors of the market, and that's how he does his trading. And he talked about how autos, auto manufacturers were down, home builders were down, retail stocks were down, banks were down, 20 to 30% in the lead up to this raise. And he uses that as a signal for how the general economy is doing, which makes sense. So I just thought I'd look at similar things in Australia. And we just had a number come out, and I think we were chatting about it before, that in December, new car sales in Australia fell 14.9% over the prior year.
Yeah.
It looks like it was actually probably the biggest percentage fall for any month since 2010. So it's a pretty big change. The question is, does that continue? But at the same time, property was down, I think 4.8% last year for Australia.
I think it was more than that, wasn't it?
National median dwelling, I think it was. And Sydney was more like 9% or something. But all those things kind of lead you towards being a bit cautious around the macro. And
we'll get some numbers on retail, no doubt, in the next month or two when the retailers start reporting their Christmas periods.
I think that's really interesting, and it'd be interesting to hear more about that as time goes by. I hope you can keep us updated. But just to play devil's advocate for a moment, a very sort of popular trope is to say, oh, stock picking's easy, just buy this company, don't worry about the macro. That's economists are wrong 9 times out of 10, and our clock's right twice a day, so just ignore macro completely. Just look at the company. Where do you sort of stand on that, or what do you think?
Yeah, good question.
Yeah, so I'm definitely bottom up. I think like both of you guys. I do look at the macro though, and I think that it's more to understand. I try and buy companies that can weather any storm, but I need to know what kind of storms are out there, I guess, if that makes sense. So, and it does affect my risk taking to a degree. So right now I'm transitioning to more cash flow positive companies rather than companies, like if it was a company that was very early in the journey and burning huge amounts of cash, that means they're very dependent on capital markets. It's probably not the right time, in my opinion, in the cycle to be doing that.
That's an interesting thing, because that's exactly what I did towards the end of last year when I sort of sold out of Nearmap and sold down a lot of Volpara. I think they're very interesting businesses. I've held them both, made good money off them, but yeah, it's just the wrong time of the cycle for that kind of business if these macro indicators are correct.
Yeah, and I think Australia, it's really weird that the Australian market to me wasn't really worrying that much. Like it wasn't nearly as volatile as the US, but to me, Australia's picture is actually weaker in a lot of ways. Like the housing market's falling. That's been holding us for a while. Now autos, sales are falling. Like where's the growth going to come from in the economy?
So what are the resources complex looking like? Because that's very important to us. I'd say if you wanted to get a read on the Australian economy, I'd add that into one of the things to keep in mind.
Yeah, I haven't dug deep on resources. I was looking a bit at China, which had its own concerns. A lot of that was the Chinese consumer slowing. Like Apple came out with that big warning.
Yeah.
But yeah, that's a good question. I think over the coming weeks, if I keep digging into this,
I think you've got this long-term structural threat that sort of China seems to oscillate between way too many apartments have been built and too many apartments have been built.
Yeah. And they just hit the credit lever the whole time, right? Just keep borrowing more or internally lending more and more. It's just gone crazy, right?
Yeah. So there's definitely oversupply then. It's just like they can keep kicking the can down the road until we're old men.
How about you, Claude? What's your view on macro? How does that inform your investing?
I'm excited that Matt's putting more time in and he's going to talk to us about it more, because I think that it's very important. Look, I bought my first shares in March 2009, and I did that for like an extremely basic macro reason, which was that I got interested in shares in 2007. It seemed very hyped up. I wasn't in a rush. I was a uni student, so I just watched, and it was the decision just not to buy anything in that period was extremely valuable. Now, I'm not saying I knew there was going to be I'm not saying I forecasted it. I'm just saying is I took the macro signal and I acted on it. And that was extremely beneficial for me, because then in 2009, even though I guess I delayed the start of my investing, it was a very safe playpen where everything was sort of rebounding off the bottom, even though I made many more mistakes then than I make now. I was in a sort of safer environment to do that. So look, I'm never going to stop caring about macro.
And where we are now, do you see some parallels? Do you feel as though it's late stage in the cycle? Is it giving you similar kind of trepidations or urges to restrain?
Yeah, so I think as we've discussed in the past podcast, I've increased my hedging. I'm short a couple of consumer stocks.
That's right. Omedia, you mentioned.
And then like there's another undisclosed one that I'm short as well. Then I've got a long-term hedge against the banks. I think right now I have put options on Commonwealth Bank and NAB, but I just basically use the banks as something to hedge against. Now, look, I often have lost money on those puts, so like it's not really something that I would advise many people do.
Is it one of those things where you're sort of happy to lose little bits here and there, but if anything goes really pear-shaped, you've got that protection?
Yeah, so with the puts, I don't just lose little bits. Like I'll buy puts. I don't know how many people understand how options work, but you're buying the right to sell the shares at a certain price, and that will expire at a certain time. Now, the advantage of doing this is you can't lose more than the money that you put in. The disadvantage is that if those aren't in a good position at the time of that expiry, like you can and will lose 100%, which I have. So I've spent, thousands of dollars over the years buying some sort of insurance against overall market downturns. And then like sort of towards the end of last year, for example, some of the puts were paying off. So then I would sell them for double or triple what I bought them for. But I think net, buying puts is still probably being a money loser for me.
But I think that's the right word you use there as insurance, right? Because you're not doing it as a monster position. It's literally a protection. And like when your house doesn't burn down, you don't regret that you bought insurance.
Right.
Do you?
Yeah,
So it's
exactly.
like
So
how you
yeah,
use
I
it.
might have burned for like the last couple of years. I've probably burnt between 2 and 3% of my portfolio value on buying some sort of insurance.
But you've had that sleep at night factor.
Yeah, and taken
But
more
also
risk
'cause
elsewhere.
the way because I've taken that has given me confidence to like, buy a big position in Volpara and then sell it, or hold my near map position for years and basically have a lot of money in like what you would consider as high risk growth stocks or micro caps, which we'll talk about later.
Yes.
And those have then generated excess returns that mean that my overall returns like above 20% per year and sometimes getting on 30. So like that puts the 2 or 3% in perspective.
Nice.
I
Andrew,
like
what's your take?
Oh, well, I like what Claude was saying there about not trying to predict, but trying to be aware. It really reminded me a lot of Howard Marks' take on that, where he tends to talk a lot about no one can predict what's going to happen with the economy, but we can have a very good idea of where we are now.
Yeah, 100%.
I really like that. And he had a memo out, I want to say a couple months ago or less than that. And he was basically saying, look, it feels late stage in the cycle. That doesn't mean anything in terms of what's going to happen tomorrow. Maybe things muddle along for a couple of years, but
the most basic thing that you can do if you take that view and you don't want to get into shorting or you don't even want to sell anything, or you don't want to let it affect your stock picking, is just make sure you're not leveraged into the market.
Yeah,
and that was
totally.
the first thing I did almost a year ago now, was basically just eliminate as much leverage as I could.
I don't tend to hedge. I tend to I'm always operating on 3 to 5 year time frames. I'm basically expecting that 1 in every 3 years is going to be a negative one. There's probably going to be, again, on average, probably going to be a big bear market every 10 years or something like that. And so what I will do though is I tend to be, and this is what I have been doing, I tend to be much more restrained in my buying. So as I manage to generate some savings, I have not really been putting that to work. So it's having the effect of sort of increasing my cash balance, I suppose. And that's
a hedge in itself.
It really is a hedge in itself. So
nice.
so there's the macro view.
Excellent.
Claude, we were going to talk a bit about micro cap.
Yeah, so zooming right
Let's
in.
go to the micro
So we've
view.
gone from the macro to the micro. Actually, before you start, define what you mean by micro cap investing.
Ooh, good question.
So I'm not a sucker for like super strict definitions here, but would probably be talking under $50 million market capitalization.
Okay. Yep.
The feature of microcap that has made me think more about microcap investing recently is in fact that those stocks that are so very small tend to be far more sensitive to company-specific developments than other companies will be. There's not a lot of hot money going in and out. At the best of times, it's usually traded more by people that are actually looking at the business. Now, the caveat here is I'm talking about companies that have probably profits you're looking for, or at least...
So it's not a penny dreadful,
or at least
specky
their cash.
kind
Well, they could still be considered that, but cash flow break even at least.
There's a business. There's at least on the way or at viability.
I have learned the hard way that for these kind of businesses, you really just want to wait until they're cash flow break even at least before really getting too involved, because anything can happen before then, and so many of them die even after being cash flow break even.
So why invest? So it's riskier, it's more illiquid, things go wrong. Why the attraction? That's Dorothy
the
Dix,
attraction is I
like them too.
It just absolutely amplifies the stock specific thing. So you can research a company, find one that's at some sort of inflection point, and then get like pretty good gains. And potentially, if you find the right stock, actually, I would argue at reasonably acceptable risk, but acceptable is in the eye of the beholder. To me, investing in microcaps is acceptable because although you may risk minus 50% as your loss when things go wrong, the gain is quite very conceivably 200%. It's really not too difficult for an $8 million company that might be earning $200K in profit, ergo on its price to earnings ratio, it actually might look quite expensive then. But just because of the way the operating leverage works, if it's sort of just become profitable, it may not need to add much gross profit to get that profit up to 2 or 3 million. And then when it's up to 2 or 3 million, it's really not that much of a stretch for it to go to a $30 million market cap, which would be a tripling of the
Tracks a higher multiple,
tripling of
gets
the
more
share
interest, bit of a virtuous loop of added liquidity and all of that kind of stuff.
Yeah,
It just,
exactly.
you know, some of the fund managers get interested in it, and it kind of that's the ideal scenario.
Yeah, exactly. I mean, especially if you're in before small cap fund managers, and then it becomes a bit of a darling, it can really become quite overvalued. And actually, probably there's some times that's happened that I should have sold but didn't. But
What's a key lookout for people entering this space for the first time?
So there are a couple. One is that I think it should only ever be like play money, except for professionals. That I think this is a high risk section of your portfolio, and you might get stuck in it. And then another thing is
when you say get stuck in it, just because it's so illiquid, it might actually, if you buy a reasonable sized position, it could take a long time to find a decent price and decent volume to get out.
Yeah, there's that as well. And also just simply like, even if everything's going well with the company, it could just be that the buy sell spread, say you wanted to buy and sell $5,000 worth of shares in these companies. You know, I'm not joking that there are a number of companies that I own that you can't buy $5,000 worth of shares without pushing the share price up 10%.
Right.
So the transaction cost, forget brokerage, the transaction cost is like very real just on the market price. So that's like one thing.
Yep.
It's not like with a more liquid company where you could perhaps buy and then do a little more research and then change your mind. So that's one aspect of it. The other aspect is it's very easy for things to change quite quickly. So it's very easy for a business to make things look pretty decent for a little while, and then everything falls apart. So I think the number one rule for microcaps is it's very advantageous if you can take the time to just sort of follow one along for like a year or something at least before really thinking about buying, which is what I've done with a lot of the microcaps in my portfolio. Is actually some of them I've actually had them on the periphery for years,
And that's to get a sense of what that volatility is like, I guess, to see what the trading, how would you react to it?
Also, just you read through their quarterly reports or their annual reports 2-3 years ago, you hear what they're saying, what they're going to do, and then you come back a little bit later and see how close that's been.
Yeah.
And, you know, even in saying that aloud, I reckon there's one microcap in my portfolio that I'm going to sell.
Can you tell us about it?
I don't. Before he sells it.
I don't want to, because there's probably good reasons I own it.
Yeah.
But in saying that aloud, you know, it's just not really got that long-term history of performing according to plan, which is what I like to see. I guess there's always exceptions to every rule, but I prefer ones that have delivered. But the other thing is I wanted to tell a cautionary tale. One company that I followed for many years and initially bought and then sold profitably was called Energy Action. Now, this should be a profitable and good business. And I had sold it when I spotted that they'd taken their focus off, I guess, their recurring revenue business and onto more the consulting side, and they'd made some bad acquisitions at too high a price. So I sold it and watched it for many years. And then the new CEO came in who was not responsible for the bad decisions, and he started to whip it into shape. And the earnings started to improve, and they delayed the dividend for half a year, which then allowed them to pay down debt. So the balance sheet started to improve.
Okay.
And
So
they
started to turn around?
like everything was looking good. We actually published a piece on ethical equities that sort of said, it's looking pretty good.
Go to the website and check it out.
Well, yeah, you can, but it was wrong because what we got sort of blindsided in that piece, they'd sort of said, and we're exploring options for corporate transactions. And I sort of said, it's never a great sign. I think it's a waste of money and a distraction to do that. Like, they were on path turning it around. Anyway, the next thing we know is the share price was up at this stage. The next thing we know is that basically the NPAT was going to be 50% lower than the prior half. And the CEO resigned with very little notice, which could not be more of a bare signal.
Yeah. So what did you do?
Well, so what had happened is, like, I'd originally, I think, recommended that, which was about 67 cents, which I thought was a compelling price. Then it had gone up to like above $1, where I'd like luckily taken a bit of profits because it was no longer such a compelling price, and I didn't feel great about this corporate action they were planning. and then got blindsided. This news happened. I knew it was going to absolutely tank. It's still sort of freaky because there are times where you want to sell and there's no buyer except down until like some opportunistic buy order down at 25 cents.
Okay.
So this is what I say
I
when
used to put those orders in.
yeah. Then like
Just in case.
Matt's sitting there at like 4 times
Have you ever had the
earnings.
broker call you when you try and put one on?
I just
and
had
then
it
he's like, you
purged.
can't do that. It'll lead to
Also-
a
Said
disorderly
ComSec
market.
purge it.
So this is actually the thing. My father-in-law, I called him and I said, "Hey, you got to sell the energy action share." So he tried to, and then like ComSec wouldn't let him.
Okay, so okay, tie this in a bow for us. What was the takeaway with this particular dalliance, and what did you learn from it?
Yeah. So what I learned from that is that with microcaps, you can just get completely blindsided, and it will really, really hurt. And that's just part.
I've had
and
that
parcel of
happen
it.
with large caps as well as small caps, but I totally take
It
your
can
point.
happen with
Yeah.
any stock, but to downgrade profit by 50%,
It's huge.
or not downgrade, to say profit would be 50% lower when previously like the guidance was all like things are trotting along, have the CEO just resign like that. That is really just out of left field, bad stuff.
Yeah.
And so it's something to be mindful of. And so again, I guess
It's a beauty and the curse, right? So it's like a very inefficient market, and so that means you can have these huge bargains and that kind of thing, but it also means there's not a lot of other people looking at it, so it can lead to these, things getting overvalued as well.
for very
Yep.
illiquid stocks, I think the lesson that reminded me of, which I had sort of applied, is that it is probably good to manage that position size pretty carefully.
Yeah.
But then on the flip side, I'd say there's some great opportunities in microcaps. Like one of my winners that has held up my portfolio in recent months, whilst the market has been struggling, is another microcap called LaserBond, which is like simply an industrial company that seems to have been doing well. There's a write-up on ethical equities on
There's
that
a bit
one.
of activity on
Nice.
Strawman with LaserBond too.
Yeah, I think we covered that at around 20 cents, and that's like over 30 cents now. And yeah, look, I bought it at lower prices, and I still think it's.
Is it a buy today though?
I wouldn't say it's a buy today. No, I don't think so.
All right, gents, listen, we better tie it up there. Thank you again for a very lovely chat. Let's not leave it so long next time. In fact, let's commit to do this exactly the same again next week.
It
Matthew?
was Christmas. What do you give me a break?
Well, some
Yeah.
people just have a higher work ethic than others, my friend.
Yeah.
and-
No, thanks for tuning in again. Look forward to another year of great investing and chatting. So yeah.
And Claude, thank you too.
Thanks for listening.
As always, we do appreciate your questions. We have got a bunch over the holidays, and we do intend to get through them. In fact,
Mailbag episode.
we're planning on doing a mailbag episode very soon. We're just going to churn through a whole bunch of them. But please send through some more questions, feedback, comments, suggestions, anything like that. You can find us on Twitter. You can also, of course, find us wherever good podcasts are sold. And if you're there, please make sure to give us a nice big rating. It helps us reach more people and continue doing what we're doing, which we
just
hope you're enjoying.
Tell your friends.
Tell your friends.
Tell
Your
your
investing
friends.
nerd friends.
Until next week, I'm Andrew Page. Thanks for listening.
Thank you.
See ya.